Good morning, everyone. Warm welcome to this session today, organized by CA Speakers Forum. Today, we are meeting for a very specific session, a session which aligns with the current requirement. The current requirement because we are into that month when we have only few days left to submit our report if the regulations apply to us. So FATCA and CRS, which applies to financial services, financial institutes, the entities which may have a related business, which may fall under that criteria, which we will get to know today. So today we have someone who is an expert in the subject. We have someone who is providing services and expertise to different countries all over the world. We have someone who is a chartered accountant. We have someone who has qualified and has gained experience for more than 16 years. And we have someone who is encouraged to share the knowledge with each one of you and with the people who are on YouTube so that we know what we have to do and we comply with it. We comply with the UAE regulations and reach to a stage where there is a global transparency. So these are international standards, FATCA and CRS, international regulations, which applies to the companies in UAE, which have a deadline for June 30th, and that is what we are here to know. So thank you, Mihir, for being here with us today. I will request everyone who is here to please warmly welcome Mihir by showing love, clap, and thumbs up, and give him a grand welcome because he is the one who is interested to share the knowledge. He is the one who made me aware about it and that it has to be done timely. And that's how we are here today with this session, which we normally do on Saturday at 11 a.m. And Mihir, before you start the session, I would like you to share for a couple of minutes what you think is most important to be shared before you go into your presentation. Thank you.
Yeah. So first of all, thank you CS Speakers Forum to have me here and provide me opportunity to share knowledge on FATCA CRS because that this is a subject where now UAE authorities have been closely monitoring because we all know that earlier UAE was in a gray list, and over the years they have made efforts to ensure that they've been removed from the gray list so that more and more countries, more and more authorities can trust UAE as an economic destination for businesses to grow. Having said that, today's more focus would be on the compliances as to
Right.
what are the steps involved in carrying out the exercise, to whom this regulations would apply, and if they apply to them, what are the next steps and the way forward to ensure that all the entities are complied with.
Right. Okay. So thank you so much for taking this initiative. I hope that maximum of our professionals from different parts of the world who may have a connection with UAE take benefit of it. And you have around 50 minutes and then 10 minutes for Q&A. And let us deep dive into it. Over to you. Thank you.
Thank you so much. Let me share the screen. Okay. So, as we see the topic, which is on global transparency, local compliance. So, why global transparency? The idea or what we are going to see in the session is that why UAE adopted this regulation because of various international countries having a specific exchange of information program through which the countries could obtain information about their investors, their persons who are paying tax in those respective countries. Now, as we move ahead for the session, what we are going to cover is firstly how the regulations came into picture, like as to when it was born, what's FATCA, what is CRS, and thereafter what are the steps involved in FATCA CRS regulations, like what financial institutions will have to do to ensure that they are doing the compliances correctly. And thereafter, how the reporting takes place on the MOF portal, and simultaneously, the additional requirement of a risk based assessment. And lastly, we'll end the session with a few practical case studies just to understand, how the audience at large have understood the regulations. So the genesis of FATCA, I would say, goes way back in 2008 and maybe prior to that, because initially the structures that were incorporated, they were having a very opaque structure. When we see opaque, there was no true disclosure of who are the ultimate beneficial owners. So there would be multiple layer of entities which were there, and thereafter a final UBO who's sitting somewhere else. So they were easily able to bypass the regulations, and they could withhold the wealth that they had earned in some different country, due to which in 2008 there was a UBS scandal whereby the US authorities started to think how this scams could be prevented in future, and that is how in 2010 US enacted FATCA, which is Foreign Account Tax Compliance Act. So the whole purpose of FATCA was, if a US citizen is investing outside his home country, then the country where he's made an investment is obliged to share information about the US citizen to the IRS. Now, how this exchange of information works is two countries would, US and India, let's say US and India enters into an intergovernmental agreement, which is IGA. Now, through this IGA, India agrees to share information of the US persons who have invested in India so that the IRS could track them as to where the US persons have invested their money and whether they are giving a true disclosure of their wealth in US. Gradually, by 2014, all other countries also understood the need for this regulation, and then the CRS was born, which is Common Reporting Standards. Though the regulation, FATCA and CRS both goes hand in hand, but there are some important changes or important regulations that one needs to keep in mind as to when the FATCA is applicable and when CRS is applicable. And as of now, we have around 120 countries who have participated in this exchange of information program. So, as I discussed, while FATCA, what was the whole purpose for which this FATCA was incorporated? To identify any US persons who would have invested outside US. Similarly, in CRS also, when we talk about the compliances, more than 120 countries are there, but UAE has adopted a model where at present it has an agreement with 96 countries. It is still in the process of entering into that multilateral agreement with those countries, but as of now, 96 countries are part of that exchange of information where each of them agree to share information. And what happens if the respective country do not comply with the FATCA or CRS regulation? In case of FATCA, any income that is earned from US or in US, there is a straight 30% withholding if proper documentation, proper forms are not submitted to the intermediaries with whom the respective UAE entity would be dealing. And likewise, in CRS, the penalties are varying and it depends on the country to country as to what sort of penalty would be levied on them. Now let's deep dive more in detail as to what exactly the FATCA is, how this works, and what all reporting happens. So firstly, as we said that when a country is entering into an agreement with IRS, that country has to ensure that all the information with respect to the US persons is being shared with the IRS. So for FATCA, most important thing is if any entity is dealing with a US person or a US citizen or any connection the person has with the US, then that person's information needs to be reported or needs to be shared with the government. So it's not that the country would directly or the entity in UAE would directly share information with the IRS. There is a process to it that we'll see in the later slides. But the idea is that the obligation is on the entity to ensure correct collation of data because at the end of the day, it's the data on which the authorities are relying. So if the data is not correct, it's messed up, it's not sanitized, then what happens? The output, the final output, which is being shared with the IRS, is the same. We all know that a garbage in and garbage out concept. So if you're putting in garbage while you're feeding the returns, it's the end result would also be going to be the same. Now, to whom this regulations would apply? This FATCA and CRS regulations largely applies to any entity who's functioning in the financial services space. Now, when we talk about financial services, it's a large space because your banking sector would be involved, your insurance companies would be involved, there would be custodians, and there would be your fund managers or your SPVs who are doing the business of managing funds for other people. So all these entities needs to ensure that first to check whether these regulations are complying and thereafter do the compliances for FATCA. So as we saw that the RFIs, when we are saying RFI, what is the reporting financial institution, which is the entity to whom this regulations would apply. They report to the Ministry of Finance, and Ministry of Finance in turn would collate the data and share it with the IRS. The reporting happens for all the FATCA CRS on 30th of June following the end of a calendar year. So one may have a question that entity is following a calendar year from July to June. So do I need to report it till June? or do I need to report it till December? So for FATCA CRS, it is based on the concept of calendar year reporting. So whatever activity that entity does in the previous calendar year, for that the reporting happens by 30th of June of the next financial year or next calendar year. Moving on, in FATCA CRS, what are the steps that are usually involved? First would be the account opening. So I'm sure many of us have, in a way, directly or indirectly done the FATCA compliance. So why I'm saying this is because we all have bank accounts in UAE, we have bank accounts in our home country as well, or maybe you would have made investments. In that case, the entity with whom you're making an investment or with whom you've opened a bank account, they would have collected your declaration as to which country you are a tax resident. And at that point in time, you provide them a self certification, which is a self declaration form that I either you would be if you are a US person, you will mention that I'm a US person. And if you come from another country as a tax resident, you will give that declaration. So that's the second stage of self certification form. Now, under FATCA, there are various forms which needs to be collected by the entity, which are W8 and W9 forms. Now, these are US forms. So, W9s are nothing but a declaration given by the US person that I am a US person, this is my US address, and giving his social security number in that W9 form. So for any US person, if he declares that I am a US person, then it is mandatory for the entity to collect W9 form because that's the basis. Because that is where the person is giving a declaration, he's providing his social security number on that form. And if you are a non US person, then you need to submit W8 forms. So even under W8, there are different categories. For individuals, it would be W8 Ben form, and for entities, it would be W8 Ben E forms. And lot many times in our past experience, we've seen that clients or the investors, they actually struggle to understand the requirement of submitting this W8 and W9 forms, which are actually essential for the correct compliance of FATCA CRS. Thereafter, once the account is opened, a declaration has been opened, the backend team or the onboarding team, they would ensure that whether there is any US indicia. Now, when we talk about US indicia, it is nothing but a data field in that form, in the self certification form, where they can identify whether there is any connection to US. Maybe it could be the place of address, it could be your birth city, it could be the telephone number provided by the investor. Basis based on that, the entity who's doing this, the onboarding team, will ensure that this details needs to be reported to the IRS. So few examples of how the entities can find what is a US indicia, or it could be a trigger point for a FATCA reporting. One is you would be having a citizenship. The other could be your place of birth, your mailing address, your telephone number, or maybe an investor would have given that, okay, fine, I'm having a bank account in US and I've given them a standing instructions that any funds which you need to pay me has to be transferred to this particular account, which is based in US. In that case also, the entire FATCA indicia triggers and reporting obligations needs to be done by that entity. So to give an example or a small case study, customer is an Indian national but he's based in UAE. He was born in New York. He does not have a passport or a citizenship document. And even he provides a declaration that is in the self certification form that I am a non US person on W8 Ben form. In this scenario, are we going to report that customer under FATCA? Audience, based on the previous discussions, if the chat box is open, you can. I would like to have your views in this as to whether this account becomes a reportable or a non-reportable. Okay, perfect. So, rightly said that the account would become a reportable account. But now let's just pause for a minute. While while the person said that he is an Indian national, he is born in US, but he does not have a citizenship. In this case, what the entity would do is first trigger is that yes, he is a FATCA reportable, but the entity would conduct an additional check that because the person is saying that he does not have a citizenship, US issues or there is a letter issued by US authorities stating that the person has renounced his citizenship, and based if the investor is able to provide that document, the account will become a non-reportable account. And if the investor does not provide that document, then his information would be reported to the IRS. Moving further to what are the CRS regulations? So, under FATCA, what we saw is if you are a US citizen or you have any connection with US, the account becomes a reportable account. But under CRS, what is the primary condition to look at is the tax residency. So when a person provides that I am a tax resident of India or I am a tax resident of Singapore, then that account becomes reportable account under CRS regulations. The second CRS framework that we see is that it is a multilateral framework. Now, when we see multilateral framework is here, the entity would enter agreements with all the participating jurisdictions together. So who all agrees that yeah, we would like to be part of this framework and we would like to have or we would be happy to share information about the investors. They enter into an agreement with those authorities, and after that the exchange of information program starts. UAE adopted FATCA and CRS in 2018. So the first exchange that started was in 2018. There are multiple authorities. We all know that UAE has multiple authorities. So there is a central bank, there is securities and commodities authorities, there is an insurance authorities, there are free zone authorities like DIFC, ADGM, Ministry of Finance. But what happens is each of the authority has been given a task to supervise for the entities that are registered with them. So, like central bank, all the banks in UAE would be governed by central bank regulations. Any entity which is based in the free zone, financial free zone like DIFC, ADGM, so those authorities are going to have control and authority over those entities. And at the end of the day, it is the Ministry of Finance who's responsible or who has to ensure that this entire exchange program is done correctly, smoothly, and in a timely manner. How the framework for CRS also works is similar to the FATCA, where the reporting entities will submit or prepare their returns and submit it to the Ministry of Finance, and Ministry of Finance in turn would exchange it with the partner jurisdictions. Now, under CRS, UAE had multiple options as to how they would like to adopt the CRS regulations. So the first one was a widest approach. Now, when we talk about widest approaches, what we discussed in the preceding slides was the exchange of information happens only between those countries who have agreed to share information. But what UAE is doing is, even if the country has not agreed to participate for exchanging information, UAE will still collect information about those accounts. Now, for example, UAE does not have exchange of information program with Gabon. So ideally, any person who's coming from or who is a tax resident of Gabon, his information need not be reported. But instead, what the UAE authorities say, you still provide information about those investors to us. We'll keep and collect the data of those investors. And as and when in future, when we agree to exchange information with that country, we have the data ready with us and it can be exchanged seamlessly. So this is to ensure that there is no duplication of work. At one go, all the information is collected by them. Second aspect was filing of nil returns. Now, in case of a nil return, there is a possibility that you would have onboarded investors, but still you don't have any reportable accounts. In that case, too, you need to file a nil report, because even if a non-filing of a nil report can lead to penal consequences. The reporting has to be in USD only, and we all know that there is a standard conversion rate of 3.6725. So any balances that are outstanding or payable to the investors as on 31st December, that amount needs to be converted into USD. Then they have allowed to use third party service providers. Many countries do not allow a third party service provider, but UAE has agreed that we will allow third party service provider who will help the entities to ensure that these compliances are done correctly. So for CRS, the most important aspect is the tax residency, and based on the tax residency, the account would be classified as a reportable or a non-reportable account. So a Indian citizen who's living and working in UAE, but he certifies that he is a tax resident of India. He is maintaining bank accounts and property in India. He has a UAE residence, visa and Emirates ID. Do we still need to report that account holder under CRS? Okay, we have one no. Okay, so this account would be a reportable account. The reason being is the person is certifying that he's a tax resident of India. So when a person based in UAE certifying that he's a tax resident of India, then the UAE entity is obliged to share that information under CRS. Now, moving further, and how the entities, while conducting this test or obligations, have to take care. Because see, what happens is that we all know a lot of individuals have moved to UAE for one specific reason, is that there is no personal income tax. So many a times it may happen that a person, he's got the UAE residency not because he's working there, but he's got an investor visa. Now, if I'm holding an investor visa, my prima facie condition to ensure that he's actually a UAE resident or not, because I may have a UAE resident, I may have an investor visa which grants me a UAE tax residency, but the investor will have, or the entity will have to do further checks in terms of whether he's staying in UAE for more than 183 days, because that's the primary condition. What is the UAE address, where he's been located? Based on these indicators, the entity can identify whether the person becomes a reportable or a non-reportable account. Now, in case of entity, what we discussed was for an individual. In case of an entity, what happens? In case of an entity, place of incorporation has to be looked into, and there is another condition about the UBOs of those entities, where the UBOs of those entities are situated. So, moving on, just a brief snapshot as to how UAE adopted this FATCA CRS guidelines. So FATCA was signed in 2015. Thereafter, the legal framework was drafted. In 2018, CRS was adopted, and the first filing happened for calendar year 2018. And now, over a period of time, UAE authorities have made significant changes in terms of the regulations, in terms of the infrastructure, and in terms of how the reporting has to be made to ensure that correct and relevant information is being captured by the entities. So what I was discussing earlier, like many a times it may happen that the structures which the entities have created, the structures are purely for tax avoidance purpose. In that case, what the regulation states is that then the entity which is performing this FATCA CRS compliance, they need to go substance over form, whereby what is the actual intention of that entity, and where are the UBOs based, what are the transactions or what are the business that the entity is carrying on. Based on that, the entities will have to find out whether really the person who's claiming to be a tax resident of UAE, or it is the other way around. Because what happens is, if these exercise or these checks are not followed, there is huge penalties by the authorities in terms of non-conducting or lapse in the due diligence process. So, having discussed about the genesis and how UAE and FATCA CRS were actually born, let's go to the next step as to when the entity, what happens when FATCA CRS is applied or will be applicable to that entity or not. So the first step or the starting point is to check what is the classification of the entity. Because why this matters the most is, When the first step is wrong, it will have a domino effect in terms of not getting out due diligence, non reporting with the authorities, and thereafter huge penal consequences. And there are audits also conducted by the authorities. So, this entire chain of events could be avoided if the classification is done correctly. So, for classification, what has to be looked is this is a small uh, decision tree that I have prepared for ease of understanding. Whether the UAE entity who is conducting or who is doing your financial business, FATCA CRS will apply to them or not. How that can be identified is if the entity is a depository. Now, depository entities are nothing but we all know who are accepting deposits in the normal course. So, those are your banks, the custodials, a lot of custodial agents who are providing custody services and whose prima facie revenue or the revenue that they earn from managing the assets, as in taking protecting the custody of those assets, is more than 20%. In that case, the entity is classified as a custodial entity. Third category is your specified insurance. So any insurance company who's providing insurance product, insurance policies, for those entities, reporting obligations do come into picture. But right now we are not discussing in detail about the specified insurance companies. That we will definitely, anybody if has any questions, we'll take that separately. More focus right now is on investment entity classification, because this is where a lot of structuring happens. A lot of entities fail to correctly classify themselves as a reportable entity or a non-reportable entity. So for investment entity, let me just go. For an investment entity, there are two tests that needs to be conducted. One is managed by test, another is gross income test. Now, what is a managed by test? Managed by test is that entity, the let's say there is a fund ABC, and that fund is being managed by the fund manager. Now, fund manager himself falls in the category of an investment entity because the revenue that it earns is from managing the assets on behalf of a third person. So, where a fund manager is managing a fund, then the fund itself gets classified as an investment financial institution. And when we talk about the gross income test, more than 50% of the gross income has to be from financial asset activities, like it could be from managing the assets for the investors. It could be from trading on behalf of the investors. It could be taking positions on behalf of the investors, financial positions. If that entity is providing these services, then the entity is classified as an investment entity by virtue of the gross income test. So once we say that if the entity falls in these four buckets, that is depository, custodial, investment, and specified insurance, it becomes a financial institution. And if the entity does not fall in these four categories, it is directly a non-reporting financial. It is not a financial institution. Now, when we say that the entity is not a financial institution, there is a further breakdown into two categories. One is your active NFE and one is your passive NFE. Active NFEs are nothing but who are primarily carrying regular business activities. When I say regular business activities, it could be any business activity that the entity is carrying on. It could be a listed entity, it could be government entity or an international organization. So if the entity falls in this category, it is classified as an active NFE. And when we say passive NFE is entity which does not fall in the active NFE criteria. But for passive also, there are certain conditions like what is the income the entity is earning, whether it is purely your interest income, your rental income, capital gains. If these sort of incomes are being earned by that entity, then the entity is classified as a passive NFE. And once the entity classifies that I'm a passive NFE, in that scenario, the entity also needs to give a disclosure about the ultimate beneficial owners in that entity. So we discussed what is a
क्या
custodial
बना रहे
institution.
मम्मी तुम अभी यार?
Yes, sir.
खिला दो ना फिर सबको इडली खाने में।
Yes, you continue.
Yes,
There's
yeah.
some mic. Yeah.
Then, so we discussed what's a custodial institution, what is depository, investment, and a specified institutions, specified insurance company.
Mihir, can you unmute because I had put mute
Sure, sure,
on
sure.
on. Yeah, that's
Yeah.
that's.
So now, just a small case study again. Entity is a family office which is registered in DIFC. It manages family investments like equities, bonds, real estates. 80% of the gross income is from these financial asset returns. And it is managed by a DIFC licensed investment advisor. Whether the entity would be classified as an FI, which is financial institution, or a NFE, which is non-financial entity. Right. The entity would be classified as a non as a financial institution because it is managed by investment advisor. Income is more than 50%. So based on these conditions, entity would be classified as a financial institution. Now we talked about controlling persons, but what really are the controlling persons, or who are actually the controlling persons, and how it can be identified. But before that, let's discuss what are the reportable jurisdictions and what are the participating jurisdictions, because this is more important in terms of just to understand. See, just doing the compliances doesn't help. It's just a tick in the checkbox, but rather to understand how the entire framework helps. That goes a long way, because many of you would also be aware that in recent past, income tax authorities had in India, they had launched a nudge program whereby they requested all the individuals to ensure that they have done correct reporting of their foreign assets. And why that drive was launched is specifically because when India received information from various countries, they exactly knew that these investors or these taxpayers have invested outside India, but they are paying taxes in India and they have not correctly disclosed those foreign assets. What's the implication is they have underreported their income, they have not shown the source of their income, which could lead to a penalty of 100% under Black Money Act. And this information that the authorities or the Indian authorities got was by virtue of this FATCA CRS framework. So it is equally important to understand who are the reportable jurisdictions, who are the participating jurisdictions. When we talk about participating jurisdictions is the third country, like in India and UAE. India has agreed to share information with UAE about their tax residents. Similarly, there is another instance where Cayman, Cayman Islands do not have an agreement with UAE for reporting purpose. So what Cayman does is Cayman do not report or share information about the tax persons who are tax residents in UAE. The other side is the reportable jurisdiction. So when I say reportable jurisdictions means UAE entities are obliged to share information about the investors who claim to be the tax residents of those countries. So as we saw that the entity classifications, your account holders, due diligences, this all matters. Why? Because it's only after that the entity will come to know whether the account needs to be reported to the authorities or whether only due diligence has to be conducted. So as we said that for controlling persons, there could be different kind of controlling persons for different entities. Now, in case of a corporate structure, in the given case, there are 5 owners. There is person A, person B, company X, who's 30% owner, person C, who's only 10% owner, and person D, who is 60% owner of company X. Now, if the entity or the investor who's classified as a passive NFE, then they have to also report about the controlling person. So, basic definition or the basic guideline for who is a controlling person is anybody who is owning more than 25% ownership in the company is classified as controlling persons. So in the given example, person A who's directly owning 35%, person B who's also owning 25% becomes a reportable person. In case of company X, which is owned by person D, who's a 60% owner, so person D becomes a reportable person, and person C, who's only owning 10%, which is below the threshold limit, is to be excluded from the controlling person. Let's look at another structure in case of a trust. So there are 4 parties in trust that we all know. One is the settlor who actually establishes the trust, the trustee who manages the assets of the trust, protector who oversees the functions of how the trustee is functioning, and lastly, the beneficiary, which is the ultimate person to whom the proceeds of this trust are going to go. Who would be a controlling person in case of a trust? So as per the OECD guidelines, all the 4 persons are classified or will qualify as a controlling person. The next rule for a controlling person is apart from the ownership. Now, many a times a lot of structures are created so that there would not be a natural person who would be owning 25%. In that case, what the guideline states is the senior managing officer who's managing the affairs of that entity will classify as controlling person. So the first stage is if the entity, like in the previous structure, there are 3 persons, that is person A, B, and C. Based on the respective shareholding, you need to identify whether they become a reportable or not. Let's say instead of this person A, B, and C, there was only one shareholder, which was company X. And then company X was in turn owned by person D who's owning more than 60%, or going step further, that there is a company X and there is no other person who could be classified as a controlling person having more than 25%. In that case, senior managing official of company X would be considered as a controlling person. A quick one for the self-certification forms. So self-certification forms are nothing but the document that we saw while the entities would collect at the time of onboarding the investor. And it's not just a document that they have to collect, they also have to check the reasonableness and the validation of those documents. So when I say validation, it means while you submit proof of, so at the time of onboarding, three documents are usually collected by the entities. One is the self-certification document, one is your proof of address, and third is your proof of identity. Now, in case of proof of address, mostly people submit their passport copies, or people submit their rent bill or their water bill. So those documents have a validity period. Now, at the time of onboarding, the entity has to ensure that the document is valid for a period of more than 6 months. Just in case of your passport, like if you want to travel to another country, there has to be a 6 months validity. Similarly, in case of onboarding, the entities have to ensure that the document should be valid for more than 6 months. If it is not, then they have to insist for another fresh set of documents. And reasonableness test checking is that you need to ensure what is the source of wealth that the person is having, what is the address that they have mentioned on the document vis-a-vis the document itself. Against this, once the entities have identified these checks, then it could be said that they have duly completed the necessary requirements of due diligence in terms of validation and reasonableness. And most important is the documents that are being collected needs to be retained for a period of 6 years after the account or after the reporting period. So what we discussed was the reasonableness testing in terms of what are the checks that they need to ensure. And against that, if you're just collecting the documents for the sake of collecting, maybe you could be sitting on a time bomb. And anytime the authorities come for inspection, there could be huge penalties in terms of not doing proper due diligences, not doing proper reporting, and so on. Since the entities that are working on FATCA CRS compliances, it is bound that the data would change. As in, earlier the investor was residing, let's say in Sharjah. Thereafter, he moved to Abu Dhabi. Or in Singapore, earlier he was in Singapore, now he's moved to Korea. These all checks and balances entities needs to have. The idea is that to do the correct reporting, because when there is a change in the country, the data goes to different authorities. So what the entities can do is they can have this change in circumstance monitoring. And how that can be achieved is every account holder has an RM. So RM is in a close connect conversation with the investor, and he understands, whether the investor, because any correspondence that needs to be sent to those investors, if there is a change, the investor would immediately inform the RM. And if there is any such changes that are happening, then the entity needs to obtain a fresh self-certification from the investor. So there is a 90-day cycle which has been provided by the OECD guidelines that within 90 days you obtain the fresh set of documents to ensure that your due diligence is correct. What happens if this 90-day period expires and there is no document, no fresh document from the investors? In that case, the entities need to ensure that the account is marked as undocumented account. So it's no harm in classifying the account as an undocumented because the entity has taken all the reasonable steps to call for a fresh set of documents, but the investor has not provided them. So if that be the situation, this all could be justified to the authorities to save from the penal provisions. Now we move forward to the reporting obligations that the entities are having. So in terms of reporting, mainly it is the account number that the investor is having with that institution. What is the tax identification number of that investor? So it could be your PAN number, it could be your social security number, it could be your any other tax number that the government of that country provides. What is the balance as on 31st December in terms of the assets which are being held? And lastly, any income that is being paid. So the income which is paid to the investor could be in terms of your interest, dividend, any sort of proceeds that you are paying, that all needs to be reported to the investors. Few checks and balances in terms of, to ensure that correct reporting or closed reporting is happening is that the account has to be linked. Now, when I say an investor could open multiple accounts with an entity, let's say for a bank, I open 5 accounts, and in all those 5 accounts, I maintain a balance which is below a threshold limit. In that case, what would happen is none of the account would come as a reportable account because it's below the threshold. So the authorities have said that first you combine all the account balances of that investor, and if it crosses the threshold, then you need to do the reporting for that account. So under CRS, there is no such threshold. Under FATCA, there is a threshold of $50,000. And for entity accounts, it is $250,000. In case of a joint account also, each account. So let's say I'm holding an account, me and my wife are holding a joint account in a fund. So whatever the fund balance is, that individual fund balance would be reported in my case as well as in my wife's case. Lastly, in terms of the currency and the negative balances, so currency, as we discussed earlier, it has to be in USD, and any negative balance that can be considered as a zero balance. So this we've already discussed earlier that how the data collection and the validation happens. Most important thing is that once the reporting is completed, the authorities, so there are multiple checks that are there on the MOF portal. One, while you are actually doing the reporting, the portal will highlight any error that is there in the template that is being used for filing. And in my past experience, what we have seen is that if the account holder is classified as a passive account holder, that corresponding controlling person information needs to be provided in that controlling person sheet. So if you don't provide that information in the controlling person sheet, your return will not be submitted. The other point is with respect to the tax ID. Many countries have tax IDs. Few countries don't have tax IDs. So if a country which provides a tax ID, then the structure has to be mentioned correctly in the form. Like in India, you have a 10-digit PAN number, which is an alphanumeric number, 5 digits, 4 numbers, and again a last digit, which is an alphabet. So if the structure is incorrect, the portal will immediately flag an error that you need to rectify that and submit the form again. Once the reporting is completed, there would still be specific query by your MOF authority that the return which you have furnished is incorrect as we have information with us. Then that correction needs to be done immediately within the time provided by the authority. In case if there is a lapse or there is a delay, then the authorities might take strict action against that entity. So few errors that are observed while reporting, as I spoke, one is the missing 10, second is the wrong classification, active, passive, or even if it is a passive, you have not reported your controlling person, incorrect jurisdiction. So for CRS, most important is your tax residency, but you are reporting just based on the residency. So that should not be done. Year-end balance, you have not calculated correctly, like the entity is not following a calendar year. So in that case, what the entity has to do is that they have to look at the balance as on 31st December and not at their year-end balance. Risk assessment. So what I would just summarize this risk assessment concept. Initially in 2022, yes, 2022 was the first year when the authorities also started calling information from the entities that you need to submit data of risk assessment. So this is nothing but your own assessment of the last reporting period as to how many account holders you onboarded, what all data you have collected. So there was this, the whole form was structured in these 8 sections, right from onboarding, whether there was pre-existing accounts, any changes, where have you, if there is you, since you're doing the reporting, whether there is a maker checker concept, do you have policies and procedures in place, what is the infrastructure that you're using, whether it is manual data or whether it is computerized system, are you providing training to your employees, and the tin numbers and the additional due diligence that you have conducted, whether you have done it correctly or not. But so this was the overall structure of the form until last calendar year. This year, what the entities have done, this year, what the authorities have done is they have moved from that linear questionnaire to a conditional logic, because one shoe cannot fit all. So now what the authorities are really looking at is, if you are doing a nil reporting, then what is the reason for nil reporting? Based on that reasoning, the next question is asked. So majority of the sections which is not applicable to that entity, they don't have to do the reporting for that as well. That saves a lot of time and effort also, because then only the relevant data is being captured by the authorities. This is most important because these are the risk areas which the entity should be aware of. One is the entity classification, how the data is being managed. Is the entity collecting data for controlling persons? What are the governance measures that the entities are having? Maker checker concept. See, even if there is a maker checker concept, but in practical, we all know that how the maker checker concept works. So they have to really ensure that there is a proper maker checker concept. Even if you are outsourcing to a third person, you need to ensure that the service provider has that proper infrastructure in place, have that relevance team who can actually undertake this obligation on behalf of the entity. Because at the end of the day, it is the reporting entity who will be liable for any error or omissions in the returns that have been submitted. So just for the reference of the audience at large, I have highlighted what are the key error areas that could happen and what is their impact. So if there is a no tin that is collected, or if it is missed out while collecting, there is very less chance of tin being collected, because as we discussed that not many entities or not many countries have tin in place. Likewise, if there is a classification errors which could be really high and which is very critical, if you are not correctly classifying your passive NFEs, or you are not collecting information about the controlling persons. So this is something the entity can actually look through this chart and identify, at is what stage the errors could happen and how it is going to impact their overall reporting. Like, like we all know that after the closure of first corporate tax filing in UAE, the FTA authorities started doing their audits, started calling for information. Similarly, even in their FATCA CRS also, the authorities start the inspection and they would like to audit that all the information which has been submitted is correct or not correct. Generally, by Jan or Feb, that is after 6 months, authorities send out notices to the respective entities where they would like to do the audits. Because, see, this audits, what I have experienced is anytime a notice is received from the authorities, the first statement is that the client gets little skeptical in terms of, oh, there is something bad which is going to happen, or the authorities are going to impose penalties and fine on us. But that's not the case. See, because if the entire process has been followed correctly, right from your classification to due diligences to the maker checker concept, everything which is there in place, then the entities need not worry because you have everything ready with you. And the idea of the audit is not to penalize the entities, but at the same time make them aware of the gaps that they would be having in their processes currently, which could be bridged by the time the next reporting season is in place. So many times what we've seen is that initially there was the first point which talks about is the policies and procedures. Right from 2018, there is no guidance as such as to what this policy and procedure document has to be. In the regulations, they have given how the due diligence has to be done, what document needs to be collected, but exactly how this document should look like, there was nothing on record. And when one fine day, when the authorities came for audit, and they were like, you don't have policy and procedures document. That's where it started thinking, like, okay, this is also because we were following the process as per the law, but they still wanted a document like an SOPs. So, every function which the corporate does, they have an SOP kind of thing. So, similar to that, why not have an SOP for FATCA CRS as well? So that's how we help clients that, okay, fine, let's have this SOP document, which you are any which ways we are following it, have that documented, have the team responsible team on there, so that tomorrow when the authorities come, they know that, okay, fine, these are the responsible persons who are given the task of FATCA CRS compliances, what processes they are following, what is the onboarding team, so that entire thing is in that one document. And most important is also on the training side. A lot of entities, while we are doing this risk-based assessments, every time what we hear is that none of them would have attended the trainings. But honestly speaking, every year authorities are conducting webinars on FATCA CRS. At least even if they are attending those trainings, that is something which can be complete, or which can be said that, okay, fine, the team who's responsible, or the SEOs who are responsible for this FATCA CRS, they have done the training correctly, or they have attended the trainings which are undertaken by the regulators. Because at the end of the day, even though you are outsourcing, but the person should be aware as to what really is this FATCA CRS. So as I said that a lot of penal provision. So just to highlight, if you're not doing your due diligence correctly, then there is a penalty of 50,000 dirham. So for each case, there is a 50,000 dirham penalty. If you are not reporting the account, or let's say you reported only the passive NFE, you did not report on the controlling person. So if there are five controlling person, for each controlling person, there is a penalty of 5,000 dirham. Now just understand that a fund who wants to do the business, but just because of lack of awareness or lack of proper compliance, all the money is being wasted in the penalty provisions. In few years back, the ADGM authorities, they actually blacklisted the entities who did not do their FATCA CRS compliance properly, and their names were reported on their website for non-compliance. So, this is the image of not doing the thing correctly is very bad. Rather than, to do it properly, to have the proper infrastructure, proper systems in place to ensure that at the end you are having a peaceful sleep. So I have few case studies. We'll just run through quickly and then we can take question answers. So there is a trust which is established in Jersey with an Indian settler who's based in UAE. There is a professional trustee who is also a Jersey-based corporate. And there are three beneficiaries. One is a UK tax resident, Indian tax resident, and a UAE tax resident. Among this, who would be qualified or who would be falling within the definition of the controlling person? Can we have the audience to answer this? Yes, Indian settler would definitely qualify. So apart from Indian settler, any other person? Okay, correct. So see, first of all, in case of a trust, all the four category of persons would be considered as a controlling person. So a settler, a trustee, beneficiaries, and a protector. In this case, there is no protector. So let's talk about the three ones. Settler. Now, settler is a UAE resident. So from a UAE perspective, I don't have to do reporting for UAE tax resident. I will be doing reporting for other than UAE residents. Because for any UAE person, UAE authorities do have his information. So they don't need any additional information under FATCA CRS. So the reporting would be for the professional trustee who's a Jersey based, the trust, which is a Jersey based, and the beneficiaries. And among also from the beneficiaries, it will be only the UK tax resident and the Indian tax resident for whom the information would be reported. Next case is of a private investment company, which is a BVI registered holding company. It is having portfolio of listed equities and bonds. 95% of income is from dividends and capital gain. It is managed by a DIFC licensed fund manager. 100% owned by a passive NFE in Cayman Island. So there is first is a 100% Cayman company, which is passive NFE. that company, Cayman company, is holding investment in the BVI company, and the BVI company is managed by the license company. So from UAE perspective, first of all, if I have to see the fund manager who is managing that BVI entity, fund manager will do the reporting as a nil, because there they don't have to, they are not actually holding any account, they're just managing it. The funds are lying in the fund. So from a fund perspective, the entity would be classified as a passive, as rightly said, that because it is held by a Cayman company and the income that is being owned is in the nature of dividends and capital gains. Now there is a change in the tax residency. So the existing British national who was UAE resident, he moved from UAE to Singapore. So he has a new Singapore address, new phone number, but the old self certification shows UK tax residency. In this case, what should the entity do? Hmm, So, can you elaborate like what you really mean by continue reporting for 3 years?
Mm. I'm turning my mic on.
Yeah.
I thought this report has to be done annually and it has to be done for 3 years. So this might have been an active uh, entity which has to perform reporting obligations, and then probably it has to continue because it was applicable for them.
Oh, okay. So, see, reporting is done by the entity who is having this customer account.
Hmm.
So that is one aspect. The question here is that the customer who initially said that I'm a British national, I'm staying in British, and these are my details. But suddenly in 2024, he moved from UK to Singapore. So the change that happened that happened only in 2024. So till 2024, you are reporting as a UK citizen, has all the details. That information is shared to the UK authority. Now in 2024, within 90 days, the reporting entity needs to collect fresh set of documents from the customer that please provide your revised self-certification form and your revised data, including your proof of identity, proof of address, which states that you are now based in Singapore. So this is the compliance that the reporting entity will have to do. And just to correct you on the part that the reporting should happen for 3 years. Ideally, once the entity qualifies as a reporting financial institution, reporting has to continue till the time either their license, they do not revoke their license to carry on a business as a financial institution, or the entity is not liquidated. So for all the years, the entity will have to do the reporting.
Cool, interesting.
Yeah. And so what are the major areas that one should actually, focus is? It's not a FATCA and CRS, they are not a reporting thing. They are end-to-end compliances because a lot of exercises are involved right from your classification, due diligence, governance, Classification has to be done correctly. This is the main stage where a lot of entities go wrong. So these things have to be done correctly to ensure that there is no uh, things don't go south. In terms of data quality also, there has to be a proper system in place. Even if a lot of people are doing it manual collection of data, they have to ensure that at least that data is proper in terms of the form is filled in correctly, no fields are left empty, and it is properly signed and dated. Even for the smallest part of not signing the form or not mentioning the date on the form, the authorities straight away say that you've not done this correctly, or you have obtained this form post dated, but you are showing that it is there since existence. Risk based assessments, as we discussed, that based on this risk data, the authorities are now evaluating which are the high risk entities for whom audit should be conducted, and which are the low risk entity for whom maybe once in 2 years or once in 3 years an audit or inspection needs to be conducted. So this is all on FATCA CRS in UAE, and I would be happy to have any questions from the audience.
Thank you. Thank you so much, Mihir. So, as we are already late by 20 minutes and we are short of time, if there are, like, we can take one or two questions, and anyone who has an interest can unmute. And yeah, Dhaval, would you like to ask any question?
No, I would like to request you and sir to have two more sessions, split this topic into two digestible
Mm,
parts, and
okay.
explain again because it is too complex for a single session.
Yes.
Yeah, yeah, right.
Completely
We will
understand,
look
sir,
into
because the act also is enacted in such a way that
it.
at one shot it's very difficult, and I do understand the time and all, but would be happy to take another sessions as and when permitted to share more in detail on each of the aspects of FATCA and CRS.
Mir
Sure.
sir, why I am saying this is that I am an auditor. I'll give you a background. I am an auditor, and you would have seen audit reports. So a typical audit report has about 6 points before the signature of the auditor who says that I confirm that everything is in order. Now
Right.
in 2019-20, I started mentioning 16 points over there.
Oh, okay.
Okay, so for 4 years straight, I have mentioned 16 points over there, and I had a long discussion with the other auditors in the country, about 100 auditors, and they said you are overdoing your work. And I was adamant that no, it is our job to check whether the company which we are auditing is compliant with other laws also, because you are clearly stating that I did not come across any other violation.
Absolutely.
Now in 24, I mean in 25, for 24, we had a plan of having 32 items over there. But 32 would have simply made the audit report too long. So we have made a procedure where the client has to confirm whether they have complied with these 32 regulations or not. And we do that for each and every client. Okay, as usual, other auditors are saying that you are overdoing it. But the point is that I'm coming from a background where I actually check whether the client is compliant or not. And I am finding this overwhelming. So imagine what others who are not even taking the basic cognizance of whether the client is compliant or not, where they are sitting. They are clueless about what FATCA and CRS is. So 99.99% auditors, I would say 99% auditors are clueless about what is happening.
No,
So
sir,
this is
absolutely,
a
sir.
very complicated topic. You need to take more sessions.
Thank
In
you.
fact, I have come across such scenarios where, the entities were specifically functioning in this sector, and suddenly one fine day, if they receive communication from the authority that you have to do FATCA CRS, first question is that we don't understand. what it is. So that's where my objective also is that, at least to spread the awareness in terms of how this regulation is there. Because see, it's not this regulation, it's overall impacting countries rating before the OECD. Because like how we are having a peer review for all the CA firms, similarly the OECD does peer review for each and every country. And if this infrastructure and the systems are not in place, they are heavily penalized, which in turn is passed down to all the entities, because that's where the data collection and data dissemination is happening.
Yeah.
So I think now many entities have understood the importance, and I'm sure that even in future going further, entities will ensure that they are compliant with this regulations.
Yeah, thank you. Thank you, Mihir.
A
So
very
any
important
last,
session.
yeah, thank you, Dhaval. Any last note before we sign off for the day, Mihir, from you?
Uh, so just to mention that I, in fact, after a long need, like, because when I also started practicing in this area, it was very
Mhm.
gray area, because there were not much guidance from the authorities. And like, you need to really go back and forth to understand how this is going to imply and all.
Right.
But I would be happy to share, like, so I can share. So I have created a group where we actually discuss on specific issues which are concerning on FATCA CRS. And
Okay.
anybody who really want to discuss more in detail, deep dive into it, I'll share the link, and we'll be happy to
Done.
discuss there.
Thank you. Thank you. Thank you.
Thank you.
Thank you so much, Dhaval. So, sorry, Mihir, Dhaval also, for your encouragement and active participation. Thank you, Usman. Thank you, everyone, those who are sending the notes on the session. Thank you to each one of you. Uh, please give a big round of applause to Mihir. Please show your love, thumbs up, and thank you to him for all you have done today for us. We are to the audience, a quick note that next week at 11 a.m. We will meet for foundation succession planning wills this session, and then next week we will do agentic AI. There have been couple of requests on IFRS standards, which we'll do 2 sessions in July. And we will end this month with international taxation. So thank you, each one of you. Please take note of it. We will be meeting every Saturday. And thank you, Mihir. Thank you once
Thank you
again.
so
Have a
much.
great Saturday ahead, everyone. Take good care of yourself.
Thank
Bye
you.
bye. Thank
Bye
you.
bye.
Bye bye.